This is Kathy with Single Mom Advice, and I want to talk to you about something that we've touched on in the other videos, but in light of the values on the homes going up and insurance going up, as a result, obviously you need more coverage, right? If your house is worth more, it's going to cost more to hedge against those hazards and the cost it would take to do the repairs and replace what's needed in case of a disaster, right? So your premiums went up, your property taxes went up because the house is valued higher. So even if the tax rate that your county is calculating it at hasn't changed, let's just say it hasn't changed, the value of your home has gone up, then the amount that you're going to pay goes up as well, right? So what can happen if you're like me and a lot of other people who didn't have 20% to put down on a home, and you have your lender, your current servicing company, collecting from you, along with the principal and interest, the amount that you will need to pay, they will pay on your behalf when it's due, your property taxes and insurance. If they're collecting that for you monthly with the rest of your mortgage payment and paying it for you annually, then that amount's gone up, your mortgage payment's gone up. You say, but the amount doesn't make any sense to me. And I just got off work, I opened my mail, and I have an escrow review. And what it shows is that the lender collected the amount that we thought it was going to cost to pay the homeowner's insurance and the property taxes, okay, last year. However, in looking at it now, those are both paid for last year. It appears that they were short because, again, they came in a little bit higher, not a lot for me, praise the Lord, not a lot. But, it would make sense that this coming year, you don't want them to be short again, right? Your insurance has to be paid in advance. Your property taxes are paid in arrears. But again, we talked about the discount you can get Florida for in November. It was paid in November at 4%, December's 3% discount. January's 2, February's 1, it's due in March, late in April. And if they're going to have to collect what they have found that it is, how much higher it is now, that's going to increase your payment. Well, it's not just the amount that you're going to need. It's that amount plus the amount you were short for last year. Okay, so you were short last year a specific amount. Let's say it wasn't a whole lot. Let's say it was $200 or $300. Well, you've got to pay that, right? They're not a lender for your taxes, so you got to pay that to them, and then you've got to pay the upcoming bills, prep for those as well. So the amount they're going to collect, is impacted by those two values. And this is if you're on a fixed rate, it's those amounts. So that's something to look at. They don't want to go below what you have in there, and they like to keep a buffer as well. So there's more to it than just that. But if you're trying to get to, how did I go from, I know this number's kind of low, but 850 to 1100, per month. That's the first place I would look. Okay. So you should be getting a review. A lot of times I didn't seem to get these before until like May, I want to say. But I got it, at the end of close of the year last year. I guess they wrapped it up and sent it out, so I got it in the mail. But so I'm not sure what your loan servicer does or when they send those out. But that's generally how that works. If you get something in the mail and you want more details specifically on how your loan was increased, your monthly payment was increased, take a look at the details, and it should explain that sort of thing. But that's generally what happens. And again, it varies as well if you're if you're not on a fixed rate, but an adjustable rate, or something that fluctuates with the rate that it's based on, the index. So that's it. I just wanted to bring that to your attention and help explain that a little bit, and I hope that helps. Thanks.